Welcome to another webinar with Sense Financial, and tonight's topic is how to protect your wealth and keep more of what's yours. I'm Dimitri with Sense Financial Services. I'm the founder and president, and I will be your host tonight. And before we jump into the main presentation and I bring Tony, I just wanted to take just a couple of minutes to share with those of you who are not very much familiar with Sense Financial what we do. We specialize in helping our clients obtain control and protect their retirement accounts. Proverbs 21:5 says that good planning and hard work leads to prosperity. And we know that you work hard for your money, and we want to come along your side and help you with that. And how we do that is by utilizing self-directed retirement accounts, self-directed IRA and 401k. Just a quick comparison: if you have a conventional retirement account, it's invested in the stock market, it's limited by the stock market, it's confined by the stock market. But with the self-directed retirement account, you have virtually unlimited investment options. You can invest in residential real estate, in tax liens and tax deeds, so real estate options, mortgage notes, trust deeds, be the bank, do the private lending. You can even buy investment real estate internationally. I have clients who've done that. You can also do conventional investments such as stocks and mutual funds, and so much more. A quick example of what we can deliver for a client. Jason is one of our older clients. He actually was looking for a solution. He had a couple of retirement accounts that were losing value in the stock market, and he was concerned about his accounts. He started research online. He found us, contacted us. I personally consulted with him, set up a self-directed solo 401k for Jason, and he made 3 investments with the money that he had. He purchased a rental property in his 401k. He invested in his brother's business, and the rest of the money he lent out as a real estate note. So essentially, he used his 401k as a bank. And immediately he started receiving $1,000 a month plus in cash flow. At that time, it's been about more than 10 years ago, actually. So his income is probably tripled now. His value of the 401k probably quadrupled. So that's the kind of results that you can expect. The benefits of the self-directed IRA and a solo 401k is that it allows you to invest in alternative assets, meaning that you get true diversification. Your investment returns are tax deferred if you're using traditional pre-tax account. If you're using a Roth, that means you get to do tax-free investing because qualified distributions from a Roth are tax-free. You can leverage your funds by using a non-recourse loan. We can set you up with the checkbook control, meaning that you eliminate the middleman, eliminate all the transaction fees. And with the self-directed solo 401k is a great tax shelter. It will potentially allow you to shelter over $70,000 of your income if you're just a solo business owner. If you're bring your spouse on board, then you can double that. Imagine the bottom line in tax savings. Huge, can be tens of thousands of dollars in tax savings. But when you invest using a self-directed IRA, there are certain restrictions. You need to be aware of the prohibited transaction rules, which are described in the internal section of the IRS code 4975 on prohibited transaction. It specifies that you cannot invest in collectibles and life insurance contracts, and your plan, IRA or 401k, cannot engage in a transaction with any disqualified person, which is yourself and your immediate family members. Just a quick overview. The bottom line is that you have the ability to invest in a whole wide range of investment options: residential real estate, commercial real estate, tax liens, trust deeds, precious metals, cryptocurrency. You can use your 401k or IRA and be the bank and lend money to others. And to illustrate this point, I'm going to use this cartoon, credit for which goes to my daughter when she was little. She drew this cartoon for me, and it still makes sense even now because just recently we experienced that drop in the stock market. Man is holding the basket, which represents a stock market. The bottom fell off. All the eggs are broken. And wife says, I thought that our investments were diversified. Well, if you are just investing in one asset class, which is stock market is, whether it's mutual funds or variety of stocks, it's still one asset class. To achieve a true diversification, you do need a self-directed account. In Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on earth. And so we offer the vehicle for you to do so. Just a quick overview of what we do. Next, I'm going to bring Tony, and Tony Watson is enrolled agent with Robert Hall and Associates. He earned his bachelor's degree in business administration from Chapman University, and today he's a tax consultant with Robert Hall and Associates. He personally manages clients with over $350 million in real estate holdings. He is also an active real estate investor, and he enjoys short-term and long-term trading. He's always looking for new strategies to implement on his clients' tax returns with the goal to help his clients keep more of their wealth and not overspend with the federal and state revenue agencies. Tony is a wealth of knowledge. Please be sure to pull your notebook and take notes. He's gonna be covering a lot of information. If you guys think of questions, be sure to type them in the chat area here, and we will get to as many questions as we can at the end. Thank you, Tony, for joining us, and take it away.
Dimitri, always a pleasure. Thank you so much for having me. Welcome, everyone. Much like Dimitri's industry, where he works to help his clients shelter income and really diversify and build wealth within their retirement account so that they have enough wealth in retirement to actually live a good retirement life. On the tax side, we work hand in hand with Sense Financial to help set our clients up for success in retirement. Today's topic is how to protect your wealth to keep more of what's yours. That's the most important thing, asset and wealth protection for the future. And, over the past 3, 4, 5 years, however long it's been since the beginning of the pandemic, I think that a lot of our clients here at Robert Hall and new clients and future clients, this will be a forever concern to them because they've lived not only possibly through the last recession, but then just, right after that last recession, it seems that we headed into this crazy kind of a tumultuous time known as in the history books moving forward as the pandemic of 2020. And I think that there's still a lot of movement in the financial world, and that's not necessarily a bad thing. I think that it should show clients and taxpayers what the potential is for them to educate themselves and learn more about how to play the game when it comes to the Internal Revenue Code. It very much is a chess game that you have to play with the IRS, and there's some do's and don'ts, just like in the 401k world where there are, non-qualified transactions and there's things that you don't want to do with the money, but it's all about playing the right game and helping retain wealth. I know that a lot of people get caught up in this whole, hey, I go to my tax guy to help me save tax, but I like to think of it a little differently. If I can help my clients save $10,000 in tax, I've helped them retain $10,000 of wealth. And a big portion of what we do here is tax planning, which involves Sense Financial and the ability to defer tax on retirement contributions, as well as diversification within that retirement account. Robert Hall and Associates has been around for quite a few years. Actually, we've been around since 1971. We process more than 10,000 tax filings annually. We've got great reviews online, so check us out online. And we won a couple awards in the Glendale, Southern California area. And as a whole, I think we're well into the $1 billion of real estate operations management and wholesaling. So we do see a lot here at Robert Hall. I myself am going on 2 decades of service with Robert Hall. Very honored to be here on behalf of the Robert Hall organization. I speak at over 140 events per year. And aside from public speaking, I am actually a tax professional. I hold a license as an enrolled agent, which is a certification under the federal government to represent clients in front of the IRS, as well as prepare taxes across all 50 states, both on the corporate side as well as the individual and estate, gift tax returns, so on and so forth. Whatever actually files a tax return, we can handle here at Robert Hall. I am by no means a one-man operation. I work alongside a wonderful senior consulting staff. We are about 55 employees strong. We work very much as a team to make sure that we provide enough grade A service to our clients. And that even if I might be on the phone with, Dimitri talking about a tax filing or a 401k investment, we do have teams in place to get those answers to those very important questions that you may have. We're kind of a one-stop shop for all of your financial needs, tax preparation being our number one service. But we do also incorporate businesses. We have our internal auditing division, financial planning, bookkeeping services. And Dimitri and Sense Financial are very much a big part of the financial planning portion of what we do here. But like I said, we're kind of a one-stop shop. That's what Bob Hall dreamed up back in 1971. He wanted all of these services under one roof. And about a decade and a half ago, we started offering free consultations. I'll remind you about this towards the end when we start to do question and answer, or the Q&A portion of today. But I will show this again. This is the best way to engage in our services to see if we're the right fit for you. We suggest to send us copies of 2 years of tax returns just to see what might have been missed or how to adjust and pivot and maybe push you in a different direction to help you max out the retirement contributions and shelter more of the income to keep more of what's yours in your own accounts. If you're not looking for a new accountant, at least sign up for the free educational webinars. Like I said, we do over 140 events per year, and all of our education is free. And for the most part, like I said, if you're not looking to onboard with a new accountant, at least get the free education from licensed tax advisors. I know that a lot of us are going on to YouTube and watching TED Talks and podcasts and all of that. And that's all great. That's all part of educating yourself and utilizing the tools that are at your fingertips. Just make sure that whoever you're listening to is a licensed advisor. There's a lot of misinformation out there these days. So make sure that you're obviously contacting, Dimitri with Sense Financial, and any referrals that he has, he's already vetted. Same with Robert Hall and Associates. We vet all of our referral sources to make sure that you're working with the right professionals in the right industries. I am not an attorney, so I'm not going to be giving any legal advice today. RHA does cater to the real estate industry along with many other industries, but we are only speaking about tax advice tonight. I may seem to step out of my lane of expertise briefly throughout the conversation of the webinar tonight, but I do want to mention that I'm not an attorney, and by no means am I giving you legal advice. And the tax advice that I'm talking about tonight, it might apply differently to each one of you. So please do not take any information from today's webinar and go and apply it on your own tax filings without consulting with your individual tax advisor first. So let's jump right into it. I want to talk briefly about just really quickly about incorporating, most people when they start off in the real estate industry, they want to make sure that they're protecting themselves. Much like with a 401k, normally there is some sort of trust or LLC involved in that filing. When you're starting off in the real estate industry and purchasing your first property or acquiring your 50th property, or maybe starting an online business, this might be a question that you have: is incorporating right for me? And just to briefly kind of break down the differences between the 3 types of entities here, the most common is the LLC. Probably the second most common is the S corporation, and then the C corporation is obviously a conversation that you'll have with your tax advisor, especially if you meet very unique and specific requirements that may warrant the C corp filing over the S corp or the LLC. I want to mention, just from a tax perspective, though, the LLC and the C corporation really aren't entities set up to save you tax. They are mainly for asset protection, for liability protection, and a little bit of an anonymity benefit. For instance, the LLC does exactly what its name entails. It limits liability. That's why it's the limited liability company. A C corporation is not really connected to you personally in any way, shape, or form. In fact, a C corporation from a tax perspective is a completely separate filed entity from anything that you own or do personally with your individual 1040 tax returns. So C corporations are mainly for the larger businesses of the world, the eBays, the Starbucks, the Amazons, the Googles of the world. Businesses that have over 100 shareholders, have tens of millions of dollars, if not billions of dollars in revenue. But there are very unique scenarios where a C corporation might actually benefit you more than the other entities. And I'll give you one very quick example of this. Let's say that you are taking care of a dependent, whether it be a parent who is a dependent or a child who is a dependent that has significant medical costs each year, in-home care, assisted care costs, and they're not filing their own tax return. They are reliant on you for more than 50% of their support. And so you have these large medical costs each year. Well, an LLC and an S corporation will not allow for the dollar for dollar deductions on the medical expense side, whereas a C corporation would allow its shareholder to not only deduct 100% of the shareholders' medical costs, but also 100% of the shareholders' dependents' medical costs. So once again, a very unique scenario where if you have that parent, that loved one that you're spending, 6, 7, 8 grand a month for assisted care, to help them out while they're at home, and they are relying on you to take care of them in their elderly age, or a child that has a medical illness. This expense needs to be a dollar for dollar write-off for you. So have this conversation with your tax advisor, open up the books and the QuickBooks or the financial statements to make sure that you have enough medical to warrant filing as a C corporation if you are a self-employed business owner. And that, once again, that's a very unique scenario, might not apply to everybody, but we do have clients here at Robert Hall who meet those specific requirements, and the C corporation absolutely, it benefits them more than the LLC or the S corp. Probably the holy grail of the entity industry or the entity selection is the subchapter S corporation. It is the only known entity to actually save you tax. Now, when it comes to retirement planning, you can have 401ks and IRAs under any one of these entities, as long as you have enough revenue stream and you're compensating yourselves in unique ways to allow you for that contribution. But above and beyond the deferral of tax through 401k contributions and IRA contributions, once you've done all of those things, once you've mapped out a plan and maxed out those deferred comp plans, you got this net revenue figure. And let's say that you've reduced that net profit down to, 100 grand, easy number to calculate off of. As an LLC and a C corporation, you're not really going to be saving any tax. The LLC is going to protect the money, but it's not going to help you shelter any of that taxable revenue. The C corporation, if you don't have large medical write-offs and you've got 100 grand of profit, the C Corp is going to pay 27% corporate tax on the federal side and about 9.3 to 10% on the state side. And then whatever you take as a dividend to your personal account under the C Corp is going to pay individual tax on that money. So we also refer to the C Corp as a double taxed entity. Whereas the S Corporation is kind of a hybrid of the LLC and the C Corp. It provides all of the great asset protection benefits of an entity, as the entity is supposed to provide you with asset protection, but then it also allows you to basically reduce the amount of self-employment tax that you'll pay as a self-employed property manager or a self-employed real estate professional, or even a self-employed medical physician, right? I mean, it depends on what type of revenue you have. So we're talking mainly to the self-employed individuals in today's webinar, which I assume all of you might be because you're looking into self-directed IRAs and solo 401ks, things like that. But the S Corporation will help you if the game is played correctly, this chess game is played correctly. The S Corp could help you reduce your self-employment tax by upwards of 60%, not 6%, but upwards of 60%. For those of you who don't know what the self-employed tax rate is, it is 15.3% of whatever your company's profit is. That's a good chunk of your profit that goes right out the door back to Social Security, Medicare, and these kind of social pots that we all have to pay into as either W-2 employees or self-employed individuals. That S Corporation will allow you to control the amount or alter and control the amount of self-employment tax that you pay. So have this conversation with your tax advisor about whether or not an entity is right for you. Incorporating is not right for everyone. And each one of these entities you see here on the screen will have different tax implications. There are miscellaneous filing fees at the state level. There's processing fees, payroll fees. I mean, there's a lot of money that goes into an entity just to keep it, up and running on an annual basis. A lot of annual fees. So let's make sure that financially it makes sense for you to take that next step. Now, for those of you who are building wealth in real estate and you're looking to shelter money and retain this wealth, and you've talked about the incorporated entity structures before with your tax advisors, well, let's squash some misconceptions, because some of you might be thinking, well, I don't need an entity. I've got a great insurance policy. Or my living trust owns all of my assets. I don't need the LLC, and I've got the insurance policy. So what does each of these things that you see here on the screen, each one of these doors, what does each door lead you into? What kind of room does it lead you into? I guess the best way to explain this. Well, the LLC is great for asset protection, but it does not provide you the same benefits as an insurance policy would provide, right? It's got no cash payout at the end of the day. But the LLC does allow you to separate business and personal assets from an asset protection standpoint, same as the C corporation or the S corporation. And so that protects you while you're alive and doing well from potential litigation type scenarios. The trust actually kicks in as a benefit when normally this one major life event happens. And that major life event is normally death, right? The trust is meant to protect your assets from probate in whatever state you hold assets in. So the trust is really meant to kick in a benefit after you're long gone and allow for that smooth transition of assets and wealth to be transferred to your heirs or your beneficiaries, hence the name beneficiary, right? The benefit goes to them. The insurance policy, the number one most important thing for us to have in business and in life, insurance actually has a cash payout at the end of the day. Now, not all insurance policies will pay out. I've worked in the tax industry for almost 20 years now, and I've heard nightmare stories about how insurance companies will drag their clients through the mud and at the end of the day not actually pay out any settlement, and then the client is stuck with the bill or whatever the cost is to repair a vehicle or to rebuild a home, so on and so forth. So each one of these doors, when you open this door and kick it down, you are going to enter into a different room. These three doors do not lead to the same room. So you want to make sure that the proper structure as you build your wealth and you acquire assets and you're doing this planning each year with your tax advisors, your legal advisors, that you know the differences between these three things. The insurance policy is there to protect you in case an unforeseen event happens, and the insurance policy should be protecting assets that are incorporated under an entity structure for greater asset protection. And then the owner of the entity, the LLC, the S Corp, or the C Corp, should not be you personally. The owner should be your living trust. And so that way you're protected at every angle, making sure that, heaven forbid, you leave your house. In fact, this is a personal example. Just this last weekend, one of my son's toys that was plugged in to a USB outlet in our kitchen, it exploded and almost burned down my house literally 4 or 5 days ago. So thank goodness we have homeowners insurance to help us repair the damage. So that's why we have insurance for that unforeseen event. And then the LLC is meant to, once again, separate the business income and the business assets from all of our personal risks and liability. And then the trust, once again, is to protect our legacy assets for our beneficiaries, our loved ones, and to make sure that they don't have to lawyer up after our death or upon death and fight the state of California for all the assets that we've worked our whole lives to obtain and leave as our legacy to our loved ones. So keep all of that in mind and definitely have these conversations with your tax advisors. Let's talk about some of the top tax deductions for not only real estate professionals, but just self-employed investors as a whole. Coming out of the pandemic, we did see quite a bit of change in spending for businesses. Because people were essentially forced to work from home. I worked from home for, almost 1.5 to 2 years because the LA Health Inspector's Office said that there's no way that Robert Hall and Associates is going to be able to see 120 people a day, Monday through Saturday for 3.5, 4 months. So they shut us down. They said that no go. So we had to reset up everything from home with cloud login technology and all of the above. Well, that was our reality, right? The reality of self-employed business owners was, okay, well, how do we weather the storm of the pandemic? How do we continue to do marketing if we can't shake hands and meet people in person? Well, the number one change in people's expenses, just from a tax return perspective, the number one change was in marketing and advertising. People were redoing their websites. They were redoing their business cards. They were sending merch and branding items to clients. They were, putting together new signs for their listings with QR codes and all of the new technology that we have to utilize at our fingertips these days. So we saw major changes in the marketing and advertising cost side of business operations. And one correlation that I saw, maybe not in 2020, but as the pandemic progressed in 2021 and 2022, I noticed that the more my clients were spending on marketing and advertising, the more secure their income was, meaning that they were weathering the storm of the pandemic in a more efficient and successful way than the people who weren't focused on marketing and advertising. So I did see a very unique correlation between the people who tripled and quadrupled their marketing efforts and how their revenue actually stayed either consistent or even grew during the pandemic. So just make sure that you understand that a tax advisor is not only there to prepare tax returns for you, but we are also here to find as many dollar for dollar write-offs for you as possible. Marketing and advertising, reinvesting your profits back into infrastructure is a dollar for dollar tax write-off for your business. So keep that in mind. Number two, kind of going along with the same kind of sentiment of the pandemic, most people were working from home or they had an office location, but no one was really coming into the office. So they had two offices at that point, like myself. So we had to upgrade our in-home office furniture, buy new computers, increase our Wi-Fi speed at home, download new security software programs, and link up with an online portal. All of this stuff that was new for us during the pandemic ended up being great tax write-offs for our business as well. So professional supplies and equipment, we saw significant spikes in this spending category for self-employed individuals. And make sure that you know what is tax deductible for your business, for your rental investments, for your non-passive type revenue streams, and how to really maximize those positions. The reason why I like this particular deduction out of all the deductions, and yes, I'm such a nerd because I really favor certain deductions over other deductions, is the fact that if I go out and I buy a computer, and let's say that I've already wiped out all of my net profit, all of the net profit of my rental property or all the net profit of my self-employed business, and I go out and I have to buy this new computer because my desktop just stopped working all of a sudden. So I go out and I buy this brand new desktop for $2,000. Well, if I'm already at a zero net profit for the tax year, I actually don't have to take the full $2,000 write-off in this year if I don't need it. The government gives us the ability to either take it fully as a Section 179 depreciated item, which means that you're accelerating the write-off in the year that you need it. And if you don't need it, you can spread the deduction out over the depreciable lifespan of the asset. Well, a piece of equipment like a computer or a router or a keyboard, a mouse, a monitor, that has a 7-year lifespan. So imagine this, instead of taking the $2,000 now, let's say I need it next year, I take 1 year out of the 7-year depreciation lifespan as a deduction. And then the following year, in year 2, I accelerate the remaining portion of the depreciation. So I take it when I need it. Same goes for furniture, the desks, the chairs, the filing cabinets, the shelving units, storage units, all of those things that you purchased for business use at the home or for your rental investments. You can either depreciate over 5 years, or you could take it all in 1 year. It's called Section 179 that allows you to accelerate that write-off. So you got to, once again, I'm not expecting you to know this to apply on your own tax filing unless you are a self-prepared taxpayer. But you want to make sure that your accountants know about these options. You want to work with these licensed advisors who know about how to play the games that are presented to us under the current and future and past Internal Revenue Codes. Another major change in the Internal Revenue Code in 2020 was the benefit of being able to buy out your leased vehicles rather than having to go out and buy a new vehicle for the potential vehicle write-off. A lot of people in 2018 you saw going out and purchasing heavyweight vehicles, the new Tesla Model X's, which I see every 15 feet on the road these days, the Chevy Tahoes, the Silverados, the Mercedes G-Wagons. I mean, there's a number of vehicles that qualify for the 6,000 pound weight class deduction. And that was good up until December 31st of 2022. It was something called 100% bonus depreciation. As long as you titled the vehicle, insured the vehicle under your business, you were allowed this heavyweight vehicle to be a dollar for dollar deduction to offset your federal taxable income. California didn't conform to that benefit, but the federal government was going to allow a $70,000 Chevy Tahoe to be a $70,000 write-off up till December 31st of 2022. Starting January 1st of 2023, there are some limitations on what you can deduct. First off, the bonus depreciation is no longer 100%. It is now decreased to 80%, and it will decrease to 60% next year, 40% the following year, 20% the next year, and then it fully exhausts at the end of its phase-out period. But you still get 80% this year. Now, there are some requirements. There's some not income thresholds, but there's some dollar classifications for vehicles that are in place, and those are potentially going to change prior to the end of the year because we have an election coming up in 2024, and obviously the Biden administration and whoever the running mate is, they're going to want to both look good on paper. So we're waiting to see where the code shifts and changes towards the end of the year, and some people might think that that's unfair for them to change things at the last minute, but the government doesn't really work in a fair way in most cases, right? They can change things literally at the 23rd hour that might impact some people, but might not be prorated back to a certain date of the year. So we're really looking forward to seeing what changes are on the horizon so we can better advise our clients as far as this deduction is concerned. So if you are that individual who was leasing a vehicle or is leasing a vehicle, you have the same potential to take this write-off. If you really like the vehicle that you drive, in 2020, the federal government, because of chip shortage issues and import exports and tariffs and just the slowdown of the supply chain during the pandemic, you are actually able to buy out your leased vehicle and convert it to a depreciable write-off, which was not a benefit prior to 2020. So there are some tricks of the trade in the industry as well, where if you need that final end of year write-off to really help you drop into a lower income bracket so we can fine tune the 401k, the profit sharing plan contribution, it might be worth, instead of going out and buying a new car, just buying out the leased vehicle that you currently drive. So these are options, and options are great from a tax perspective, from a legal perspective. You always want to know what your options are. And that's what we're here as tax professionals to bring to the table. Number 4, legal and professional fees. Most people in 2018, when the tax reform bill in that year passed, they had made a very clear distinction that legal and professional fees were no longer tax deductible. That was kind of one of the big parts of the 2018 tax reform bill. However, they didn't mention anything about the self-employed individual. Basically, they were saying that your tax preparation fees, your attorney fees, if you were a W-2 employee with a company, you could no longer write those expenses off on the federal return against your W-2 income. Well, California never conformed to that, so legal and professional fees are still deductible on the state return, against W-2 income, but not on the federal side anymore. If you're self-employed or if you have rental property income, legal and professional fees are still a tax write-off. That's the craziest thing. They were clear about the W-2 employee not being able to write this off, but they didn't really pull out and magnify the portion of the code that still allows self-employed individuals and real estate investors to deduct these expenses. So your tax prep fees, your attorney fees still are a potential write-off for you. So don't leave those out from your bookkeeping when you go to meet with your tax advisor. Make sure that you're including all of that, and then let the tax advisor and the tax professionals sift through the expenses and make sure that we're taking the deductions that are allowable tax write-offs. Okay. Last but not least, number 5, property deductions. This could include not only your mortgage interest, your property tax write-offs for the rental property side of things, but also on the primary residence, but then also the in-home office deduction. I have to say that I've had more conversations with clients over my 18, 19-year career about why their previous preparer wasn't taking the in-home office deduction. And the number one reason was because it was one of the highest risks for audit for the taxpayer. Well, if you are working with a tax advisor that tells you that you shouldn't take an allowable deduction out of fear of increased risk of audit, you're working with the wrong tax advisor. There's a whole portion of the Internal Revenue Code that allows us to take portions of our home as in-home office deductions. I'll tell you right now that after years of case study and every year we have about 1,000 hours of education, we look at case studies specifically each year to make sure that where we are pushing the envelope and playing this chess game, that we are doing it in the right ways. And I can tell you right now, after hours and hours and years of case study, it's not the form of the in-home office that gets people audited. It's the misallocation of square footage within the home that gets people audited, or that throws up the red flags, as you've probably heard people say. And we don't want to throw up red flags, but we also don't want to lose out on a very, a valuable deduction on the return. So once again, I can't sit here and tell all of you to take 25% of your house as a write-off, because I might live in a 1,000 square foot home and you might live in a 5,000 square foot home. Well, 25% of 1,000 square foot is 250 square feet. That's a reasonable sized office inside of a house. 25% of 5,000 square feet, that's over 1,000 square feet of your property that you're saying is solely used for business purposes. And if that is true, once again, you still should not fear taking the write-off. If that truly is true, I mean, I have sound recording artists that built or converted their garages into sound recording studios, and then they also have their professional office inside of their house in one of the rooms, plus the nearest restroom gets to be added to that square footage. So there are very unique scenarios where 1,000 square feet might actually be the allocable space for office use. But just be reasonable with the allocation, be as exact as possible. But at the end of the day, don't fear taking this as a write-off. And that's the in-home office side. And we've seen, obviously through the pandemic, most people working from home, we saw a lot more in-home office deductions coming out of the pandemic. I think that we're going to see that number continue to increase because people are not returning to brick and mortar. I'm sitting here in my Glendale office right now, so I have returned to brick and mortar, but there are a lot of other industries that just don't see the value in leasing commercial property anymore. So do not fear taking this write-off. That's on the in-home office side. For the residential rental investment or even commercial rental investments, there really are no limitations to what you can write off as long as those expenses pertain to the business itself. If you improve the property, if you have mortgage interest debt on the property, if you've got property taxes, obviously we have property taxes on all property. If you've got homeowners insurance or rental property insurance, if you've got legal and professional fees for advice or tax planning on the rental property side, and then obviously you've got the beautiful deduction of depreciation on your rental property. So there's really no limit to what you can write off on a rental property because it's a business. And as long as those deductions that you're taking are ordinary, necessary, and legitimate business write-offs, those are allowable deductions to help reduce property cash flow. And that's a really very unique thing about the business of rental property ownership is that you really can get kind of creative with these deductions within the four walls of the Internal Revenue Code. And there's very much something called interpretation of the code. I've heard from new clients and clients in webinars about how their accountants wouldn't allow them to do things, or they said it wasn't possible. And I'm thinking, well, that's not what I've read, and that's not what I've seen under case study. And so, interpretation of the code is different from, tax preparer to tax preparer and CPA to EA. Everybody kind of views things differently. So just make sure that, in your gut, if you feel like your accountant isn't doing enough to advise you or find creative ways to shelter more income, your gut normally isn't wrong, right? So at least get a second opinion of the work that's being done for you. And you might be surprised. I know that people have these long 20, 30-year relationships with their accountants, but some accountants get very set in their ways. They're kind of entering into retirement. They're a one-person shop and they do the necessary education, but they don't want to shake things up. They don't want to go above and beyond that call of service. And this is not the time, especially in today's economic climate, to fear or shy away from really maximizing those benefits on your individual and business return. So keep that in mind. Last but not least, the mortgage interest and the property deductions on a primary residence. A lot of clients thought that in 2018, when the 2018 tax reform bill was passed, that the mortgage interest deduction for primary residencies and rental properties were limited to the first $750,000 of property acquisition debt, meaning that if I had $1.2 million loan on a primary residence or a rental property, as of 2018, most taxpayers thought I could only take the interest expense on the first $750,000 of debt, which on a primary residence, that is the case, but only if you purchased that primary residence after December 15th of 2017. If you had already purchased that property and had a loan above $750,000, you were allowed, or you were grandfathered into the old Internal Revenue Code, which allowed you the interest expense on the first $1 million of acquisition debt. So yes, there was a slight adjustment in 2018, and it's still in place, but that is not $750,000 total between primary residence and second home and rental property. That is $750,000 per property for a primary and a second home. And there is no limit to the interest deduction if it is a rental investment. So that's the crazy thing about rental property, is that it is a business. So there is no limit to the mortgage interest deduction on a residential rental property or a commercial rental property. On the primary residence, and if you're lucky enough to have a second home, a vacation home, not a rental property, but truly a second home elsewhere, maybe in the mountains, in the desert, by the beach, or in another state, that interest deduction is on $750,000 for the second home and $750,000 for the primary residence. Now, that is on the federal side. California never conformed to that part of the Internal Revenue Code. So when you file your return, your interest deduction might be lower on the federal side than it is on the state side. and new clients that were coming in during 2018, 19, 20, 21, and us taking a look at previous year's returns, we realized that their accountants were taking the 750 limit on both the federal and the state returns. They weren't making the adjustment for the state side to allow for the interest expense on $1 million rather than 750. So you got, once again, you got to make sure that you're working with tax advisors that know not only federal tax code, but also some of the things that certain states didn't conform to in 2018 and also under the Inflation Reduction Act, which was passed earlier this year. So keep all of that in mind. I know that that was a long-winded slide, but I wanted to make sure we covered that as much as possible. For the rental property connoisseurs, for the newbie rental investors, this topic kind of hits home for me in more than just a couple ways, not only as a tax advisor, but as a real estate investor myself. Something happened during the pandemic where I think that people were at home more obviously, and they were starting to educate themselves, listening to webinars, YouTube, wherever they were going for their education. And during the pandemic, I saw more people and more questions come across my desk and in webinars about cost segregation than collectively over my 18 plus year career, which is crazy to me because cost segregation has been around for a while, and I've always pitched that to my clients and kind of explained how it worked. But I did more cost segregation elections on returns in the last 2-3 years than collectively, once again, over my 18-year career. So I like the direction that people are going in. They're educating themselves. They're learning more about some of the benefits of elections, special elections under the Internal Revenue Code. And for those of you today who don't know what cost segregation is, I'm going to break it down for you. I'm going to explain to you how this really works. The best way I've learned to explain this is by giving an example. This is a real life example, a real world example. A client came to me specifically at the firm in 2021. He had just acquired some new properties in 2021. In 2020, and he was coming to us in 2021 to file the 2020 returns. And obviously, as you could see here on the 2021 column, he's got a nice W-2 income of 120 grand. He's got some interest income, some dividend income, some capital gains. And then right below capital gain, you see this rent, royalty, partnership, S Corp, trust income. Well, ignore the royalty, partnership, S Corp, trust terms. That 33 grand is all cash flow from his real estate investments. This individual had inherited some money from a loved one and didn't have anywhere to plug it except for real estate. So he went out and bought 3 properties, all cash, no debt. And from day one, he started cash flowing, right? Lucky guy to be able to do that, but unlucky that he had to wait for a loved one to pass, right? I mean, there's always that catch-22 here. But he comes to us in 2021. He says, listen, I want to buy more real estate. I see what kind of liability I'm receiving here. Is there anything else that I could do to help reduce this rental cash flow and pay less tax on the rental property income? And I had already gone through all the Q&A about, well, how's the kitchen looking? How's the bathroom looking? How's the landscaping, the foundation? Is there anything that you need to improve? And he said, no, these properties are livable condition. I'm not looking to put $100,000 kitchen into these properties. They're fine, and I'll fix and repair things as they break. And maybe eventually down the road, I'll repair them, but they're all livable condition. And I said, okay, well, then you would be a perfect candidate for cost segregation. And he looked at me and he said, well, I said, cost seg. And he goes, oh, it sounds like a new variant of COVID. And I said, no, cost seg is not a new variant of COVID. Cost seg stands for cost segregation. And this is the ability to basically reach forward into future years and accelerate future year depreciation write-offs to take all in this year. And we might be able to use all of it. We might be able to use some of it, but we will never lose it, right? We'll use what we need, and then we'll carry forward what we don't need. Because in this particular scenario, this client, taxpayer A, is not a real estate professional. This is a city worker making 120 grand W-2. So this taxpayer A is going to be limited on the amount of loss deductions he can take through his real estate portfolio. So originally, before the cost seg election was made, we sent the numbers off to our cost seg specialist, and they came back with the analysis, and we ran some numbers. Originally, first off, right out the gate, he was owing about $4,018 to the federal government, and to the state of California, he was owing about $4,200. This was including about 33 grand in cash flow from his 3 properties. So we ran the numbers on the cost seg election, and we applied them on the return, and we were able to take roughly about a $40,000 deduction on the accelerated bonus depreciation that we were able to take through this cost seg election. Now, once again, depreciation is the building value itself from all 3 of these properties, the building deducted over 27.5 years. So residential rental property has a 27.5-year lifespan. Commercial has 39-year lifespan. And so what we're trying to do is, instead of waiting 27 and a half years to get these write-offs, we're trying to reach forward into those future years and capture the deduction now to save the money now and buy more real estate, right? That's the goal here. So out of this $400,000 accelerated depreciation figure that we were able to take through cost seg, he was allowed $40,000 in this year because he's not a real estate professional. Otherwise, he would have been allowed the full 400 grand as a real estate professional, but we were allowed 40 grand. So there was a limit. He's got $360,000 left over, which is carrying forward to 2022. So we'll put that to the side as a side note. But that $40,000 loss that he was able to take dropped his 33 grand profit into a loss of $11,549. And instead of owing $4,000 to the IRS, he's now looking at just shy of $6,000 in federal refund and a state refund of about $1,392. So it saved him about 15 grand in overall tax just in 2021. I mean, on 2021's tax return, or this is 2021. So he came to us in 2022. My apologies. So 2021. Now we've got $360,000 of carry forward accelerated depreciation ready to offset his cash flow in 2022, and then in 2023 and in 2024. And now, I mean, fast forward to 2023, when we sat down with him and did some planning, he had saved up enough money to buy another property in 2022. And guess what we did with that property in 2022? We did another cost seg election. So the goal here is, now I think he's got about $550,000 in carry forward depreciation. And let's just assume, for numbers' sake, that he is seeing about 33 grand in profit per year. If we've got $550,000 just waiting in the wing as a deduction, and he's got an average of 33 grand per year in overall cash flow for the next 16 years, if he didn't buy another property, for the next 16 years, he would pay zero income tax, federal and state, on 33 grand of cash flow every single year. Okay. That's the power behind cost segregation, is the ability to take the deduction now when you need it, to plug that money back into real estate and take advantage of some of these accelerated depreciation benefits under the cost seg election. And the greatest thing about this is that it's accepted on the federal side and the state side, unlike other things that are only accepted on the federal side and not conformed to on the state side, or vice versa. So just to whet your palate on cost seg, I'm sure that there's going to be questions on that, but we'll get to that in a second. Section 1031, thank goodness at the 23rd hour, the federal government decided not to change one of the oldest parts of the Internal Revenue Code, Section 1031. It's over 100 years old. And this is something that not only generates or not only provides the global economy with over 600,000 jobs globally, right? Global economy, over 600,000 jobs, but makes up for more than 65% of United States real estate transactions. That's the 1031 exchange. They were trying to cap the amount of deferral in the exchange to a $500,000 per taxpayer, $1 million for a married filing joint couple, and then everything above and beyond that in capital gain and recapture depreciation would then be taxed. But at the 23rd hour, they decided to squash that. They didn't end up changing it. So still, Section 1031, another holy grail of the Internal Revenue Code, is still no limit to what you can exchange and defer from actual real property, tangible property, into other real tangible property. Prior to 2018, you were allowed to exchange business assets. If you had a classic car collection, you could exchange it for another classic car collection. If you had fine jewelry, you could exchange it for another fine jewelry or like kind asset. But in 2018, the Trump administration fine-tuned Section 1031 and said that you can only exchange real property under Section 1031. So, and this is both on the federal and the state side. So this is essentially kicking the tax can down the road. Not even until you kick the can, it's just kicking it down the road. Because when you kick the can, your heirs, your beneficiaries, more likely than not will receive a tax-free stepped-up basis upon death, which could make up to whatever the estate exemption is down the road. At the moment, it's up to $12.3 million per taxpayer. Basically, your children, if they inherit your property in death, at the moment, they receive, $25 million roughly in real estate tax-free. So the goal here is to kick that can down the road until you kick the can and pass that benefit on to your beneficiaries. Okay. So very, very unique part of the Internal Revenue Code. Last but not least, QBI, also not another variant of COVID. QBI stands for Qualified Business Income. And this is for the real estate investors of the world, the self-employed individuals of the world. If your taxable income as a married filing joint couple, under the left-hand column, the blue column, If you're married filing joint, your taxable income is below $329,800. If you're single, go to the red column, single head of household. Your taxable income is below $164,900. The first 20% of your property cash flow and or self-employed profit is tax-free. This is probably the most significant tax code gift that we have received as business owners and real estate investors, I'd say ever. To be real honest with you, this came about in 2018 under the Trump administration, where they were giving the business owners of the world and the real estate investors of the world, if they met specific income requirements, a 20% tax-free benefit. That applies on the federal side. It does not apply on the state side. But as you can imagine, let's say my wife and I are married filing joint. Let's say I make 150 grand self-employed profit. She makes 150 grand self-employed profit. We're at 300 grand, let's say, in taxable income. We're below the $329,800 threshold. So we qualify for the full QBI benefit, which makes 20% of our 300 grand in qualified business income tax-free. That's $60,000 of income that we pay not a single dime of federal tax on in this calendar year. So the phase in, phase out thresholds change every year based on inflation and economic climate and whatnot. But this was the phase out for 2022, 329,800, 164,900 is single. And if you are above those upper thresholds, you are starting to phase out from being allowed this benefit. So it's a very unique credit and tax code benefit that you can receive, which makes the importance of year-end planning that much more important. I don't know how else to put it, but if you're sitting at above this threshold and it's December 1st, you need to set aside some time to talk with your tax advisors to figure out creative ways to reduce your taxable income threshold to qualify for the 20% QBI benefit. This is where I plug Dimitri and Sense Financial, because if you are not maxing out your 401k, profit sharing plans, self-directed IRA investments, those are great ways to dollar for dollar reduce taxable income, not only funding your future retirement and saving yourself, retaining the wealth on all of that dollar amount, but you might also be dropping yourself low enough in your income bracket to qualify for 20% of your QBI, qualified business income, tax-free. We love that phrase. I love that phrase. You should love that phrase, tax-free. You got to figure out as many ways to qualify for these tax-free benefits as possible. And once again, I told you that I was going to end on this slide just to make sure you knew how to capture our information. If you're tech savvy, you open up your smartphone camera, you scan the QR code, it'll give you a link to press and you can sign up for a free consultation that way. Or you could just text the words Robert Hall to the number 72,000. That'll automatically prompt you to sign up for this free consultation. Once again, we'll review 2 years of tax returns, check for any possible audit red flags or triggers on the return. And if you're not looking to onboard or we're just not the right fit for you, at least let us add you to our free educational webinar division, eBlasts. Once again, we do about 140 events a year, and it's all free education. So, I think this is a great time to open up for Q&A, Dimitri. Thank you once again for having me. Thank you, everybody, for sitting in and listening. But I'm ready to rock and roll for any questions that you might have.
Thank you so much, Tony. What a wealth of information. Yes, we do have several questions, so let's jump into them. First question, should I buy a new or slightly used vehicle for my business?
What makes more sense? Yeah. Great question. You're talking to a person that has never bought a brand new vehicle in their life. I grew up in a household where, whatever vehicle you bought, you drove it until the wheels fell off. And obviously, as I built my career as a tax professional and wanted some nicer, safer vehicles for my wife and my family, to protect my children, I have bought vehicles under my own business. But personally, and this is not a professional opinion, but personally speaking, I think a 1 or 2 year old model is just as good as a brand new vehicle. So it doesn't have to be brand new to get this benefit, this depreciation write-off. It just has to be new to you, meaning that you cannot. I'm sorry, I take that back. Well, prior to 2020, it didn't have to be new. It could be the vehicle you're looking at your front window, at that vehicle that you're leasing that's sitting in your driveway. You can actually buy out that vehicle. Now, the one thing that I wanted to mention is that if you already own the vehicle and it's in your driveway, you can't sell that vehicle to your business because it's not new to you. But you can buy out the lease and take the depreciation write-off. That is a possibility. But for those of you who are looking for new vehicles, some of you want that brand new vehicle, and at that point, you're paying a premium for it, right? Cars, as soon as you drive them off the lot, they start depreciating in value. So a 1 or 2 year old model is just fine. And you still achieve the same tax deductible benefit at a lower overall purchase price. Still a great overall 80% deduction, because remember that it's 80% starting in 2023. It was 100% last year. Still a massive dollar for dollar adjustment to federal taxable income. So to answer your question, it's really up to you at the end of the day, but I would go, if you're looking for my personal opinion. Professionally, I have to tell you that how it works code wise, but personally speaking, yeah, it doesn't have to be new. Go and buy something that has low mileage on it and has all the safety requirements if you're looking for safety. But you got to make sure that you Google the gross weight of the vehicle, not the curb weight of the vehicle, but the gross weight of the vehicle, because some vehicles weigh 5,950 pounds and they don't qualify for that bonus depreciation 80% benefit. You got to make sure that the gross weight is over 6,000 pounds.
Gotcha. Thank you so much, Tony. Definitely makes sense. Next question. How much salary should I take from my S corporation?
Yeah, great question. I get this a lot. And this is something that probably is a daily, not daily, but weekly conversation about people when they start their businesses and they want to take money out of their businesses or corporations. I like to wait until fourth quarter to dial in the actual payroll calculation, simply because the reasonable salary calculation, reasonable salary distribution should be a finely tuned number. Like I mentioned earlier, when we were talking about the entity structures, the whole goal under an S corporation is to avoid self-employment tax on up to 60+% of your company's profit. Well, that means that 40% of your company's net profit needs to be a W-2 and 60% needs to be left as flow-through profit under your corporation. That's really maximizing the reasonable salary benefit here. So you pay Social Security, Medicare on 40% of the profit as the W-2, which is payroll tax, and on 60% of the profit, you avoid paying the payroll tax. So as far as what you should take out of your business's salary, for the first, second, and third quarter, if you want to take money out of an S corporation, for instance, you should only draw from the company account. You should not issue salary in the first, second, and third quarter. You should wait until you have your year-to-date income, year-to-date expenses dialed in closer to the fourth quarter in order to make that determined calculation of the 40% reasonable salary. That way you are maximizing the benefit under that subchapter S corporation. For a C corporation, yeah, there's a little bit more calculating involved in that, because you don't want to leave net revenue in the C corp, because it's once again taxed at the corporate level. And then if you take anything to your personal account, you pay tax individually as a dividend payout. LLCs don't play the reasonable salary calculation, because LLCs, once again, are not tax savings entities. They just pass through all of the profit to you personally, and you're subject to all of the income tax on whatever that number is. So the subchapter S corporation is really a calculated number. I don't want to tell you to go ahead and take 20 grand from your business. It really all comes down to what your net profit is based on your year-to-date income and year-to-date expenses, as close to, if not in the middle of the fourth quarter of the year. And that's what brings in the important topic of year-end planning. You got to set aside an hour or 2 hours of your time in the fourth quarter to do some tax planning. And that way there's no surprises. Come tax time, we can calculate your 401k contributions, your profit share contributions. We can give you the deadlines for those contributions. And once we've maximized all of those angles for deferred retirement, car purchasing, bonus depreciation, and we've got that bottom line net figure, that's the number that we use the 40% reasonable salary calculation off of. The greatest fear that I have is that if I tell you to go ahead and start taking a salary now, and let's say third and fourth quarter really died down business-wise, especially in the entertainment industry right now with the strike going on, I have clients saying, hey, I was taking a salary in first and second quarter, but now I'm not making anything because of the strike. Do I still need to pay myself? Well, I say, no, stop paying yourself if you don't have revenue coming in. Because at that point, you'd be over contributing to Social Security, Medicare, basically flushing money down the drains of those social pots. You will still have Social Security, Medicare credits later on down the line, but you don't want to over contribute. That's my greatest fear. So once again, we got to dial in those numbers closer to the end of the year.
Sure, makes sense. Question from Jenny. She's asking, do you see any problems with buying a rental, doing the cost seg on it, and then a year or two later converting that into a residence?
Yeah, great question. So I've had a lot of people, because of economic reasons, because of personal situations where they've lost a loved one or they become disabled in their workplace. where these major life-changing events allow you to actually move into your rental property. Because once again, if the revenue stream ceases to exist, or you lose a loved one, and because of mental issues, and just like you can't possibly get up and go to work every morning, that you can't, you don't have the finances to hold on to the rental property and pay rent or mortgage where you currently live. Because of these life-changing conditions and situations, you are actually able to move into your rental property. I have yet in my 18, 19-year career to see an audit in conversion of a rental property to a primary residence. I'm not saying that it's not possible, but you have to be ready to prove to the IRS that because of financial hardship, major life-changing event, that you couldn't continue living in a property and owning this rental investment. So therefore, you made the financial decision because of the hardship to move into your rental property. So to answer your question, you could do cost seg, get the benefit now, and 2 years down the road, if you have no other option, yes, you can move into your rental property, and there is no recaptured depreciation. There's no capital gain tax involved because you haven't sold the property. But once again, if you're going to play that, I'm going to call it a game. It's not a game that you're playing, but if you're going to play that game, you got to play it pretty close to the chest. You have to have somewhat of a long-winded conversation with your tax advisor just to make sure that all of your T's are crossed, I's are dotted, and that you understand what needs to happen in order to make that possible, if that makes sense.
Gotcha. Thank you. Well, we're past the hour, so let's squeeze one more question here. Any loopholes around $750,000 limit on a primary mortgage?
Yeah. So the only, I wouldn't call it a loophole, but I would say that it's more of like an interpretation of the code. If you have obviously an ADU built onto your property, or an allocated portion of your property as a rental per portion of your property. Let's say that not even that you're full blown renting it out, but let's say that you own a corporation and you are renting out space inside of your house. Well, the $750,000 limit is on your primary residence. I have seen in the past, and we don't have any case study on this yet, but because 2018 wasn't that long ago, I know that it seems like it was a long time ago, but it takes 2, 3, 4 years for the code to really kind of find its settled in position. And so we haven't seen any case study on this, but I have seen some unique positions where you can take the overage of interest and allocate it to the in-home office portion. You could take the allocated overage of interest and allocate it towards investment interest in some cases. So if you have interest income from a note that you didn't do through your 401k, obviously, because the 401k is all deferred. But if you do note financing on the personal side and you've got 30, 40, 50 grand of interest income that you're reporting in the calendar year, that overage of interest on your primary residence, if you allocate it to investment interest expense, not mortgage interest expense, it will then help offset the interest income that has liability on the personal side. So there's a couple of unique positions, nothing once again that's tested against an audit case study wise yet. I'm really, really looking forward to when that starts to get tested under audit. But there are some unique positions that you can take, and we can talk more in detail about that during a free consultation or during a consultation of any sort. But there are some workarounds for that are possible for people, but not really applied to everybody. I think that we need to take a look at your specific situation, make sure that it applies to you in that case. If once again, if that makes sense.
Gotcha. Well, thank you so much, Tony. Great information, great insight. Thank you guys for joining us. We're gonna conclude it here, and we look forward to seeing you at the next webinar.